While the country is not struggling with skyrocketing inflation like the US and UK, there is another problem. The world's manufacturers are suddenly finding fewer buyers for their products, both at home and abroad. In this video, we are going to talk about China and how its economy is going to be in very bad shape. So buckle up and let's hop into the video to know more about it. Weak currency. A weak currency scares investors and triggers uncertainty in financial markets. All of this comes at a time when the stakes are very high for President Xi Jinping, who looks set to secure an unprecedented third term in the Communist Party Congress. Zero COVID is troublesome. The COVID outbreak in several cities, including manufacturing hubs such as Shenzhen and Tianjin, has had an impact on economic activity in these industries. People also don't spend money on things like food and drink, retail, or tourism, which emphasizes basic services. The recovery came as the government spent more on infrastructure. However, this happened after 2 months of not expanding production. And that raises questions, especially after a private survey showed that factory activity did indeed decline in September, with demand hitting production, orders, and employment. Beijing is not doing enough. Beijing stepped in, announcing a 1 trillion yuan plan in August to boost small businesses, infrastructure, and real estate. But officials could do more to spur spending to meet growth and jobs targets. Property market in crisis. It has hit the economy hard, with real estate and other industries contributing up to a third of China's gross domestic product. The demand for new housing has decreased, and this has reduced the need to import goods for construction. Despite Beijing's efforts to support the housing market, home prices in dozens of cities have fallen more than 20% this year. With developers under pressure, analysts say authorities may need to do more to restore confidence in the property market. Climate change. Extreme weather conditions are starting to have a big impact on China's industry. The increasing demand for air conditioning has led to grid overload in a region that relies almost entirely on hydroelectricity. Factories, including major manufacturers such as iPhone makers Foxconn and Tesla, have been forced to reduce hours or close altogether. Loss of investors. The government's crackdown on the Chinese tech giant, now in the making for 2 years, has not helped. Tencent and Alibaba both reported their first revenue declines in the last quarter, with Tencent's revenue dropping 50% while Alibaba's net revenue halved. Tens of thousands of young workers have lost their jobs, contributing to an employment crisis that leaves 1 in 5 children aged 16 to 24 unemployed. This could jeopardize China's productivity and growth in the long run. Investors are also feeling this shift in Beijing, as some of China's most successful private companies are under increasing scrutiny as power grows. While state-owned companies appear to be gaining support, foreign investors are taking money off the table. The Japanese SoftBank has withdrawn large sums of cash from Alibaba, while Warren Buffett's Berkshire Hathaway is selling its stake in electric vehicle maker BYD. Tencent has invested more than $7 billion in the second half of this year alone. The world is getting used to the fact that Beijing may not be as open to business as it once was, but Xi is risking the economic success that has propelled China in recent decades. The economic will deteriorate more. The economy will continue to deteriorate in the coming months, Raymond Zheng, chief economist for Greater China at ANZ Research, said in a news report. Local authorities will be more likely to prioritize zero COVID and suppress virus outbreaks as the party Congress approaches, he added. Tightening COVID restrictions will hurt consumption and investment during China's Golden September, Silver October, which is traditionally the peak season for home sales, a news outlet said. Meanwhile, even a sharp slowdown in the global economy does not bode well for China's growth, Young said, as weak demand from the US and European markets will weigh on Chinese exports. He now expects China's GDP to grow by just 3% this year, well short of Beijing's official target of 5.5%. Other analysts are even more pessimistic. Nomura lowered its forecast to 2.7% this week. The latest data suggests China's economy could head in another bad direction in the third quarter, after GDP grew just 0.4% year-on-year in the second quarter, slowing sharply from 4.8% growth in the first quarter. A private sector survey released last week showed that China's manufacturing sector contracted in August for the first time in 3 months, while service sector growth slowed. Labor market. In addition, China's labor market has deteriorated in recent months. The latest figures show that the unemployment rate among 16 to 24-year-olds hit an all-time high of 19% in July, a record 4th month in a row, meaning that China currently has around 21 million unemployed youth. This statistic contains the number of rural unemployed. The deepening decline in the real estate market is another major constraint. The sector, which accounts for up to 30% of China's GDP, has been crippled since 2020 by the government's campaign to curb reckless lending and speculative trade. Real estate prices fell, and so did new home sales. It is difficult to overstate how disappointing the Chinese economy has performed so far in 2022. At the start of the year, discussions focused on the potential strength of the recovery and which sectors could lead the recovery. In contrast, the lockdowns shattered that narrative, as the economy contracted more than 10% year-on-year in the second quarter, posting only 0.4% annualized real GDP growth. Households have been hardest hit by COVID-19 restrictions and the resulting uncertainty about employment and income from the services sector, which has held back consumption. Financial stress is also emerging in many places, from bank protests in Hainan to increasing boycotts of mortgage payments to accelerated defaults by real estate developers. Real estate is the epicenter. The real estate sector is expected to be at the center of the storm, as it accounts for about 24% of China's GDP, an equal share of total employment, and about 30 to 35% of total borrowing. A viral post on social media in mid-August showed local officials urging their subordinates to buy properties, even if they already owned multiple homes. Revenue from home sales has fallen 31.4% so far in 2022, leaving developers unable to complete homes sold in 2020 and 2021. They are now seeking financial assistance from Beijing. The real estate sector must always slow growth in 2022, dwarfing any spike in infrastructure investment, but COVID-19-related restrictions have accelerated and deepened the economic correction that was inevitable. Starting in late 2016, Beijing launched a debt reduction campaign, acknowledging that credit growth, averaging 18.1% from 2007 to 2016, was too fast, and that conditions in the financial system were unsustainable and needed urgent improvement. These efforts have halved credit growth since 2017 by shrinking the shadow banking system and cutting a large number of borrowers and financial institutions. Grasping Shadows, a new project by Rhodium Group and CSIS, set to launch in early 2023, will more comprehensively assess the impact of China's deleveraging campaign on China's economic and financial stability. Wall of debt. The Chinese government views local economic statistics as problematic because aggregate local GDP data far exceeds the Chinese GDP announced by the central government. In addition, regional statistics do not match the estimates of the central government, so local statistics are doubtful. This situation stems from the core practice of the party leadership in setting annual GDP growth targets to be achieved by the end of the year and making it mandatory to meet the targets announced at the annual CCP meetings. In a Chinese-style market economy where finance and investment are controlled by the Communist Party, it is easy to manipulate the GDP growth rate, which usually depends on the market supply-demand balance. China's GDP consists roughly of fixed investment, household consumption, and exports. While the party cannot control household consumption and exports, it can plan investments in fixed capital, which accounts for more than 40% of GDP. So what do you think? Let's discuss this in the comment section below. If you like this episode, feel free to look around the channel. Thanks for watching. You have been watching World Economy, and I will see you soon for the next episode. Cheers, and have a wonderful day.